Thank you. Thank you for inviting me, and it's an honor to be speaking at the plenary of my favorite conference. So I've been asked to prepare something on fiscal policy, and I've also been asked to avoid presenting a 200 equation stock flow consistent model. So don't worry. If you're interested in that, you can come to tomorrow's section in the morning. So what about fiscal policy in monetary union? And I will talk only about the Eurozone. And as you all know, the architecture of the treaties and the statute of the ECB were designed to avoid for domestic fiscal policies to interfere with monetary policy. So the idea, the mainstream theory behind the treaties is that markets are able to self-adjust. The only institution which is needed is a central bank which should be independent from the governments, and we should only target inflation, not even target unemployment as the Fed does. And domestic governments should just play within the rules, and the rules are to avoid a deficit which is larger than 3% of GDP, and to avoid a debt which is larger than 60% of GDP. Because the idea is that if governments did not have this constraint, they would ask for the central bank to monetize excessive deficits for electoral purposes and so on. So, as Wynne Godley said in 1993, when the treaties were being discussed, if they only thought of a central bank as the only needed institution, they obviously meant that no other institution like a Eurozone treasury was needed. So there was no need for a European fiscal policy. So can I stop here then? And no fiscal policy in a monetary union. But as you know, things have changed because reality does not adapt so easily to the mainstream theory. And what happened with the Great Recession of 2007 was that fiscal policy got rehabilitated. As you all know, the central banks, first in the United States and then in Europe, had to bring the interest rates down to zero, and then they had no further weapons until they started the QE. So fiscal policy regained a role. I will not talk about the United States, but in Europe, what some governments did very quickly was to save the banks that were going underwater because of their exposure to US toxic assets. Germany was one of such countries. So I've taken this data out of the financial sector statistics published by Eurostat, and they are yearly averages. So for instance, Germany spent 10 billion, transferred 10 billion euro each year to the banking sector. Spain transferred 13 billion each year during the 2009-2012 period. So fiscal policy is not, this kind of fiscal policy is not what we usually think as a fiscal policy, but this created obviously large government deficits which piled up in large government debts for some countries, notably Ireland, but also Spain. Then we started with the Greek crisis, and trouble started for other countries in the later period of 2013 to present, notably Greece and Italy, and they also had to save their banks, and they transferred a large amount of funds to these banks. So this is a kind of policy that does not create jobs, it's just transferring private debt into public debt, but nevertheless creates a constraint for the governments to come. So I will go now very quickly because most of the things are well known. Some of them were very well discussed by George Bibo yesterday. But the idea is that fiscal policies play a different role in different periods since the introduction of the euro. In the first years of the euro, everything went well, but there were asymmetries which were building up trouble, in particular because a common interest rate meant different real interest rates depending on domestic inflation rates. So countries in the periphery with higher inflation rates which could borrow from the ECB at the same rate as Germany, had lower real interest rates, while a country like Germany did not have this much of an advantage. The other effect was through the exchange rate, and it worked in a sense in the opposite direction. A common exchange rate to the dollar meant that countries like Italy or Greece with larger inflation rates were losing competitiveness, while countries with lower inflation rate or lower wage rate were gaining competitiveness. So the common rules meant different impact for different regions. And fiscal policy was used in some countries to counter this effect, but not as much. In another study that I cannot present here, we have shown that in Italy, fiscal policy was used in the 60s and the 70s to achieve full employment, or to try to achieve full employment, by rebalancing what was happening to the current account. So if exports were doing well and demand was growing because of exports, fiscal policy was not expansionary. But if the balance of payment went down, then the government was interested in expanding the deficit, so to keep unemployment going up. This kind of counter-cyclical policies were not longer available with the Maastricht rules. Then we had the Great Recession. The Great Recession, as already mentioned, had asymmetric effects on countries depending on their exposure to financial markets, but also to their dependency on the United States as a destination market, and that means Germany, but also Italy to a great extent. And then we had the real start of the Eurozone crisis with Papandreou in Greece, when markets realized that the ECB would play by the rule. My feeling is that before the Papandreou crisis, markets would think that if a country would go into trouble, the politicians would say, okay, yes, we have the treaties, but now let's help these poor guys to get out of trouble, because we're all Europeans, we are all in a common Europe, which is for peace and prosperity, so they would be financed. With Papandreou, markets discovered that this was not the case, so that if a country went into trouble, it had to solve the problem by its own, and the ECB was not going to the rescue. And so we had the divergence in the interest rates for different countries depending on their perceived risk. So this is the period where the interest rate in Greece went up to the sky, and more or less at the same time the interest rate in Italy went up. And this implied lower growth, especially for the countries in trouble. In 2014, 2015, we can formally say that the recession was over, but the countries in the periphery are growing at a very slow rate. The countries in the core are also not doing so well. And so, we are still stuck with the problem, which is reflected in the level of unemployment in the different countries. I thought I had another slide here. Yes, so this vindicated another godless prophecy, which has also been mentioned and attributed to others who also foresaw it in time, that the rules of the game of fiscal policy in the Eurozone were such to impose a disinflationary bias. So we can briefly look at some statistics. How much time do I have now? Well, never mind. Briefly look at some statistics which confirm what I said before. The debt of governments increased in different periods according to different countries, but in some countries obviously was higher already at the beginning, and in others was lower. But in some countries, notably also Spain, the problem started much later with the euro. In Greece, the problem exacerbated with the crisis rather than being addressed by austerity. This chart has been normalized to 60, which is the limit that countries, according to the Maastricht Treaty, should achieve. And this one is the deficit, which so is closely correlated to the other one, but now we have this, no, this is not in reverse. A higher deficit means a taller bar, and it also has a 3% deficit as the normalizing the horizontal axis. But what may be more interesting to understand fiscal policy is the primary balance, so the deficit net of interest payments, because interest payments are largely out of control from individual governments. And for instance, one interesting thing here is that Italy, which is the main culprit today of European troubles, has one of the largest series of primary surpluses in the Eurozone. So the Italian fiscal policy has not been profligated, they've not been spending so much relative to other countries, but they have an inherited large interest payment burden, and therefore this is why they still have a large overall deficit. We could also spend some time discussing whether this public debt is sustainable or not. And as you may, I think all of you already know, a debt is sustainable, a public debt is sustainable relative to GDP when the growth rate of the economy is larger than the interest rate. And this can be discussed either in nominal terms or in real terms. So in this chart, I have drawn the real GDP growth and the real interest rate for these four countries. And you can see that by looking at the overall picture, it looks like the problem is not so much the interest rate, but the rate of growth. So the policies which have been adopted have brought down the rate of growth of the economy, and this makes the debt less sustainable. So the tools to regain sustainability should work on two fronts. On one front should be keep the interest rates as low as possible, and the ECB has done whatever it could, but a lot more could be done for countries like Italy or Greece. The other front is the growth rate, and this is more difficult to achieve, and I'll get back to this later. So when with the Greek crisis it became clear that the Eurozone rules were not working, there were several attempts to fix the rules. And I'm basing a part of this presentation on a presentation by Jan Kregel last year at Accademia dei Lincei. And there have been a number of new regulations, but they're all going in the direction of constraining fiscal policy more and more. Now, with the so-called fiscal compact, countries which have a debt which is larger than 60% should reduce this debt by a given percentage each year. So this implies that they have to run an overall fiscal surplus. And we will see in a minute what this implies. Quantitative easing has helped a lot with countries like Italy, but I guess that the next speaker will talk more about it. I wanted to focus a little more on the interrelation between the fiscal deficit and the current account balance, which in my view is the key. So many of you, or maybe all of you, know how the financial balances come out from, they can be derived by the GDP identity. By adding taxes and transfers, we can move from the GDP identity to an identity between the net acquisition of financial assets of the private sector as a whole, which is the given by saving less investment, so the excess of saving over investment. So if this is positive, the private sector is accumulating some kind of financial asset. If this is negative, the private sector as a whole is borrowing. So it is borrowing from one of the other sectors. It's usually never borrowing from the government, so it will be borrowing from the rest of the world. So this means that the country is into a net foreign, as a negative balance of payment position, is building up foreign debt, and we all know that this is dangerous, much more dangerous than a fiscal deficit. So we can discuss how these are interrelated by using this chart, which has been proposed by Rob Parenteau, and is now incorporated at least into one macro textbook. So on the horizontal axis, we have the current account, so a surplus on the right, deficit on the left, and the fiscal surplus on the top and the fiscal deficit on the bottom, so that the diagonal is the locus where the private sector is in equilibrium, is neither borrowing nor lending. So when we are above the diagonal, the private sector is borrowing, and therefore we are in trouble. And when we are below the diagonal, the private sector is accumulating financial assets, so things are relatively safe. So you could say, but why don't we always stay here at zero? So this, in theory, is a nice, neat solution, and which can be achieved only if you have some stabilizer. So maybe you have an exchange rate which clears the current account. You have a government which clears the budget, and the implication will be that saving by the private sector will be equal to the investment by the private sector. But Godley and associates showed in the 80s that usually countries do not like this kind of position because the private sector wants to accumulate some financial assets, some financial claims. Now, we can discuss why it is so. It may be related to uncertainty, Keynesian uncertainty, and the need to have some kind of liquid insurance in the forms of some liquid asset. But if you have some liquid asset, somebody else has some liquid liability. So who is going to be the debtor, which is the counterpart of the private sector creditor position? And the answer can be either the rest of the world or the government sector. So the idea is that if the government sector is providing these financial assets and is therefore running a debt, this can be sustainable. While if it is the foreign sector which is getting into debt, then you are transferring problems to somewhere else in the world. Now, with the fiscal compact and the Maastricht rules, basically countries, especially countries with a large public debt, are forced to go to this little triangle up here because they need to achieve a fiscal surplus, so they want to be above the zero line, but you don't want them to get into debt and default. So the only area where they can accumulate assets without getting into debt is this triangle. And this is the result of the Maastricht rules. So this is a chart from Eurostat data for the Eurozone in 19 countries, and you can see that indeed on average they moved over there. They started in 1995 with deficits which are way too large with respect to the Maastricht Treaty. Then for the crisis they had a number of counterclockwise movements, but then in the last few years they moved in the right triangle. Obviously this is not so easy, and different countries are doing this at different rates of speed. Spain, same story, started here, and with the recent adjustment is moving towards the triangle, but it's not here yet, so it's still in a deficit position. Greece also managed to get here, but has now overdone it, so it's now into a net debtor position. And Italy is still on the way, but you can see all the countries at this counterclockwise movement trying to get to surplus with the rest of the world, and or either a very small public deficit or a small public surplus. So this is one reason why we are in stagnation, and also this is the reason why our growth is so fragile. These are the financial balances over time, which tell more or less the same story. The same story here would be that countries like Italy and Spain have to improve their external balance, which is the black line, and this is what they did after the crisis. And the reason why they were into a bad situation is because the black line, their current account balance, was deteriorating up to 2009. So how do they achieve this? With a proper exchange rate, they could have devalued. With the euro, they had to cut wages, cut prices, and hope that this would be sufficient. Greece has done this by a great deal. Italy has also done this, but this obviously reduces domestic demand. So you need to hope that the increase in net exports, which comes out of your internal devaluation, offsets the effects on domestic demand and consumption of the domestic devaluation. So this is where we are now, as far as I can see. I think that part of the reason why the ECB did the quantitative easing was also to keep the value of the euro low relative to the dollar, so that this could benefit the net exports of the Eurozone area. But I don't think that this is a good strategy, especially now with Mr. Trump and his tariffs. Monetary policy will be the topic of the next talk. My view is that the quantitative easing program has failed to deliver in terms of restoring credit to the private sector. It has achieved other objectives, but I also think that Draghi did whatever he could do given his mandate. And actually, Draghi has been saying again and again and again that fiscal policy is needed to get the Eurozone out of trouble. So he said this in the last two press releases I checked before my presentation, but he said this again yesterday in his last press release. He again talked about fiscal policy and the need for a fiscal policy. But what kind of fiscal policy has Draghi in mind? Because if you read the transcripts, he obviously never says what fiscal policy should be about, because this is none of his business. No, he's a central banker. He should not tell governments what to do. But actually tells them in private letters what to do, but not in public, as you should know. Anyway, in his famous Jackson Hole speech in 2014, he made a reference to a paper by Alessina, Favero, and Giavazzi, three Bocconi boys, or maybe grown-up boys, which is called The Output Effect of Fiscal Consolidation Plans. So I checked this paper, and basically they estimate a kind of a VAR, and they find that if you stimulate the economy by reducing taxes, or this is the other way around, if you want to stop the economy by raising taxes, you have a much longer and deep effect than if you reduce expenditure. So the proposal that they do, which was repeated a week ago by Alessina and Giavazzi in Corriere della Sera, the main Italian newspaper, is to reduce taxes, but lowering what they call unproductive fiscal expenditure so that the budget is not affected. So will this kind of policy work? And it all depends on the value of the multiplier. So when I was young, many years ago, they taught me of the theorem, the balanced budget theorem, which said if you increase expenditure and you increase taxation so that the deficit is unchanged, you will stimulate the economy. So these guys are saying exactly the opposite. So who knows? But fortunately, Sebastian Geckert has run a meta-analysis of multipliers. And what I understand from his meta-analysis is that this value of these multipliers has an ideological bias, but on average, the idea of Favero and Giavazzi is not supported by the evidence of many research. So if this is what they want to use as fiscal policy, my view is that this is going to be a failure, and it will obviously increase the probability of a stagnating Eurozone, rising of, parties like Lega Nord in Italy and so on. I've shown you that the Eurozone as a whole has become increasingly dependent on net exports, and now the US is probably going to go into a recession. The developing markets in Asia may be slowing down. So if we depend for our future on other markets, we may be in a bad position. So there is no alternative. Obviously, there are alternatives. The first alternative would be to go back to my first godly quote, to create a European treasury. So to create a large European budget which can be used in one way or another in a counter-cyclical way. But I understand that this is completely out of the agenda and is not on the table of any discussion. So this, I don't think, is going to materialize. So what we have proposed to do is to regain fiscal space by introducing what we call fiscal currencies in domestic economies in the Eurozone. So the idea is that everybody is concerned about the value of the euro, and they are very much concerned that countries in trouble like Greece or, more importantly, Italy could say, okay, with the euro rules, we are stuck in poverty, so we want to get out. So fiscal currencies should increase the stability of the euro by guaranteeing, increasing the probability that the governments pay back in euro their debt to foreigners, but it should allow domestic governments to run a deficit in these fiscal currencies. I don't have time to go into the details. There was a proposal of this kind, which was one of the least effective by the previous government in Italy. A proposal of this kind was made by Varoufakis for Greece, so we can discuss them if you want during the Q&A session. I will just conclude by saying that, in my view, fiscal policy in the Eurozone should go back to its main target in the 60s and the 70s, which was to ensure full employment at a decent wage. Proposals for a job guarantee or giving the government the role of employer of last resort are being discussed also in this conference, and I think they are one way to go. Thank you.